Hello, everyone. If I had to start buying stocks again from scratch, knowing what I know about how fast this market can shake people out, how quickly fear can turn into FOMO, and what usually happens when quality names finally give you a real discount, I would build my watch list very differently. Now, today is Saturday, April 18th in New York, so comment below what day and date you're watching from. And if you value the way I break this stuff down, support the channel by subscribing and by commenting John AG Best so I know you're here with me. Because let's be honest, this week had people feeling pretty good. Screens were green, portfolios were breathing again, and that mood shift happened fast. Maybe too fast. That's the part people miss. When markets bounce this hard in a short window, everybody suddenly feels like a genius again. But the easy money on the first snapback might already be gone. And when that happens, the game changes from panic buying to selective patience. Even inside a strong tape, not everything was partying. Netflix got smacked, and that's interesting, because the headline numbers look strong at first glance. Revenue was up in the mid-teens, profit beat expectations, the ad business is still tracking for a huge year, and yet the market still said, yeah, not enough. Why? Because the next quarter looks softer on growth, content costs are front-loaded, and when expectations run hot, even good news can trade like bad news. Add in Reed Hastings stepping away from the board at the end of his term, and suddenly that red candle makes a little more sense. That's why I keep coming back to the bigger picture. This rebound has happened way faster than the last ugly pullback. Last time, the market sank harder and took its sweet time climbing back. This time, the drop was shallower, the bounce was faster, and a lot of charts already look stretched. Based on recent market levels, you don't need a crystal ball to say some names are running hot. You just need eyes. That doesn't mean the move is fake. It means chasing everything right here could be how you turn a good setup into a bad entry. And just so I'm clear, when I say the market was green, I mean broad green. Cybersecurity looked healthy. Big tech mostly held up. Fintech had life. Semis had life. Even the names that weren't ripping still felt steadier than they did during the panic phase. That kind of breadth is exactly why I get a little careful after a rebound. Broad green is great. Broad green after a violent snapback can also mean the market needs a breather before the next leg. That's normal. That's not bearish. That's just how markets breathe. And on the long-term side, I also think people make a mistake by treating every account the same. Some positions are there because I want to compound quietly for years. Those are the names where I can happily think in terms of Meta, Amazon, Google, maybe Tesla, maybe a top e-commerce compounder in Latin America, and then just leave them alone unless the thesis really changes. Other positions are more tactical, where I'm still long-term bullish, but I'm much more aware of entry points. Mixing those two styles together is how people end up overtrading their best ideas and underthinking their risk. So am I calling for some dramatic crash? No, I'm not doing the end of the world routine. I'm also not pretending every ticker should be bought at any price just because momentum feels good. If you've been buying aggressively into weakness these past few weeks, there's nothing wrong with slowing down, raising a little dry powder, or simply waiting for the market to hand you a better pitch. Sometimes the smartest move is not swinging at the next shiny thing. Sometimes it's standing there and letting the setup come to you. But here's the part that matters. I'm still bullish on a handful of names. Very bullish. Not because they're cheap on every metric today. Some of them absolutely are not. But because if the market throws a tantrum again, I already know which shelves I'm walking toward. I'm not shopping for stories. I'm shopping for businesses I'd be happy to own through noise, through headlines, through those weird red weeks where people suddenly forget what they liked 5 minutes earlier. First one is Nebius, and this one has been one of the wild stories in the market. I've loved it, I've respected the move, and I also think this is where discipline matters. The company ended last year with annualized run rate revenue of around $1.25 billion, said demand outran capacity, and guided this year towards something in the low $3 billion range. Then you layer in that giant capacity agreement tied to Meta, the major strategic investment from NVIDIA, and the fresh financing push to scale faster, and you can see why the stock has gone into beast mode. That's the good news. The bad news is simple. When a name gets this loved, even a bullish person like me has to stop pretending price doesn't matter. So would I chase Nebius up here just because it feels unstoppable? Probably not. Not with the stock sitting in that nosebleed zone. Not after a move like this. I still think we may be early in the business story, but that does not mean we are early in every single entry point. Those are two different things. If this thing pulls back hard into a real fear pocket, especially on dilution worries or market-wide selling, then my ears perk up again. And let me challenge one lazy idea here. Not every hyper-growth stock deserves infinite valuation just because the narrative is hot. Great story, yes. Guaranteed smooth ride, absolutely not. Guaranteed. Then there's SoFi. This one is a very different animal, and that's exactly why I like it. The latest publicly available guidance points to roughly 4.5 to nearly 5 billion in adjusted net revenue this year, around 30% growth and earnings that are expected to keep compounding strongly over the next several years. They've also already put a date on the next earnings report, so this isn't some vague, maybe someday catalyst. It's coming. And that matters, because this stock lives in that zone where one good quarter can be shrugged off, but a string of good quarters starts forcing people to re-rate the business whether they want to or not. What I keep hearing is, well, it's just a bank, so it should trade like a bank. I don't buy that cleanly. A traditional bank doesn't usually grow like this across members, products, tech infrastructure, and newer verticals all at once. That said, I'm not going to be silly about it either. Consumer credit still matters. The macro still matters. If the economy softens more than expected, sentiment can turn ugly on this name in a hurry. So for me, this is not about blind worship. It's about knowing that anything around the high teens, and especially any serious flush lower, is the kind of gift box I pay attention to. Next is AMD. And man, this one hurts a little because I didn't press as hard as I should have when the window was better. That happens. You don't catch everything. But the reason it stays on my list is obvious. From recent company filings, AMD just came off a record year. Management is talking about strong momentum going into this year, and the data center AI angle is not some side hobby anymore. It's becoming central to the story. The stock has run, yes. The valuation is not sleepy, yes. But if you believe the next few years bring a lot more earnings power than the market used to think, then a pullback in AMD is not something I fear. It's something I want to use. Now, would I call AMD a screaming bargain compared with every other mega cap tech name? No. And that's where I disagree with some of the more breathless takes. Nvidia is still a monster. Meta is still cheaper on some forward looks. There are other giants with incredible businesses too. So the point is not that AMD is the only horse. The point is that if the market gives me a rough day, or better yet a rough week, this is still one of the few semiconductor names where I'd gladly lean in rather than hide under the desk. Rocket Lab is another one where I already liked the business, already owned the story, and still wish I had bought more when the stock got tossed around. Since then, the company has posted a record revenue year, grown backlog sharply, and just completed the Mynaric acquisition, which deepens the space systems side of the business. That matters. Because a lot of people still look at Rocket Lab like it's only a launch story, when in reality it's trying to become something much broader than that. The market sees it. That's why the multiple stays rich. But with Rocket Lab, let's not kid ourselves. Neutron is the hinge. Delay it a little, the market can live with that. Blow up the thesis with a terrible first showing, that's a different story. So I actually don't mind the company taking its time if it increases the odds of a stronger first outing. I'd rather wait and get competence than rush and get fireworks for the wrong reason. Also, once SpaceX becomes a cleaner public comparison point, you could absolutely get one of those classic buy the rumor, sell the news reactions across the space basket. That would not shock me one bit. And if that creates a real dip, I'll be interested. Very interested. Then we get to Meta. This was one of the easier buys for me on weakness because the business quality never really left. The market just got nervous, and nervous markets do dumb things. Since then, the stock has ripped back toward the high 600s, and the company has kept feeding the AI narrative with new product momentum. Over the last couple of weeks alone, Meta rolled out Muse Spark for its AI assistant and kept pushing more consumer-facing AI experiences into the ecosystem. That may not immediately show up in next week's mood swing, but strategically, it matters. This is a company with scale, cash, distribution, and now a fresh reason for investors to stay excited. So yes, I'd still buy Meta on a red day. Maybe not because I'm desperate, maybe not because I think the stock can never fall, but because when you get a business of this quality trading even a little sloppily while the long-term machine is still humming, I pay attention. If it drifts back toward the low 600s on some market wobble, I'm probably there. And for the people who think every mature megacap should be treated like dead money, I'd say this. Sometimes maturity plus cash flow plus product velocity is exactly what you want when the tape gets shaky. And yes, I do keep different buckets in my head. There are active names where I'll trade around position size a little, and there are longer hold names where I mostly want to sit on my hands and let time do the heavy lifting. That's why I can buy aggressively in one account and barely touch another. Different goals, different moods, same principle. Own businesses you actually respect. Then stop acting shocked every time volatility shows up and does what volatility always does. There are also a few names I don't need a full market correction to keep watching right here. Uber still interests me. Rubrik still interests me. Shift 4 is not offensive to me at these levels. And after that post-earnings hit, even Netflix becomes one of those a few shares here and there situations, rather than an all-or-nothing drama show. You don't need the whole market to fall apart to find a couple of good entries. Sometimes one stock has its own bad day and hands you the opportunity by itself. That's enough. Now let me flip to the part people are not talking about carefully enough: software, creative tools, the whole "don't worry, it's already priced in" crowd. You know the joke, right? Meteor in the sky, dinosaurs looking up, one of them saying, "Relax, it's priced in." Funny line. Terrible investment process. Because sometimes the market prices in a slowdown, and sometimes it has not fully priced in a business model punch to the face. Those are not the same thing. Anthropic just gave the market a fresh reason to revisit that fear. Claude Design is now out in research preview, and it's aimed right into the workflow zone that people usually associate with Adobe, Figma, Canva, decks, prototypes, one-pagers, and the whole visual production pipeline. That is real pressure. Not hypothetical pressure. Real pressure. But here's my counterpoint, because I don't want to be lazy about this either. A new AI tool does not automatically kill incumbents overnight. Distribution matters, enterprise workflow matters, switching costs matter, brand trust matters. So I'm not in the camp saying Adobe is finished. I am in the camp saying the easy days for design software multiples may be over. That's also why I want your questions, because when I look at this setup, I don't just want to know which stock goes down today. I want to know which model survives, which company adapts, which margin structure bends, and which management team actually understands what's coming. That's the deeper game. And that game matters a lot more than one noisy Friday candle. So that's my list. Nebius on a meaningful reset. SoFi on weakness and maybe even without it. AMD if the market gives me a second shot. Rocket Lab if momentum cools or the sector gets hit. Meta whenever short-term fear meets long-term quality. And then a smaller basket of names I can still nibble without waiting for thunder and lightning. That's the framework. Not panic, not prediction. Preparation right now. And one more thing before I wrap this up. If you're successful, share your success story in the comments so others can stay motivated. Because a lot of people who bought when things felt awful are the same people smiling today. Those ugly, uncomfortable weeks often turn into the best entries in hindsight. Not always, but often enough that you can't afford to freeze every time the market gets emotional. Build the list before the fear arrives. Know your prices before the headlines hit. And when the crowd starts screaming, you won't need therapy. You'll need conviction. Enjoy your weekend. Stay sharp. Stay patient. And remember, this is me sharing how I think through the market so you can sharpen your own process. It's for education, for perspective, and for serious discussion, not a personalized instruction sheet for your money.